Hey, welcome to a special episode of the Note Close Show. Hope you are doing well. Today's episode, I want to talk about the distressed commercial real estate markets out there. Now, if you've been following me on YouTube or TikTok or any other social media platforms, you've been seeing I've started to post a few photos of distressed assets, foreclosure numbers, things like that, because I think it's all very relevant for what we're doing as note investors. Where is the distress at? Where can you find opportunities and stuff like that? And you're probably going to continue to see us do 3, 4 videos a week just on specific assets that pop up the commercial distress list. Now, the question I get from a lot of people is how do we come across these numbers? How do we come across this type of information so that you go direct to source? Well, we've had these guys on that provide this information in the past. It's our friends out of Philadelphia, big Cowboys fans. I'm just joking. But the guys and the team over at CREDiQ. Now, one of the great things that they do is they track the commercial default, payment default rates every month, every quarter. And they've got a great article out that talks about how the April numbers really exceeded and broke default rates in the commercial space. Let me pull this up for you guys so you guys can see what I'm talking about. Here it is. Here is the full article. We'll put the link in the description so you guys can read the full article because it's really valuable, very insightful. CredIQ's distressed rate sets a new record led by multifamily. Now, I'm going to put a little asterisk next to it because the led by multifamily, a big chunk of that is because of one multifamily loan, one huge multifamily loan. Now, the CredIQ research team completed its monthly top-down evaluation of payment statuses for each loan along with special servicing stats. April saw CredIQ's distress rate reach a new all-time high of 8.35%. That's a commercial. Now, why is that number important? Well, A, if you compare it to the residential side, remember back in, especially if you watch all the Big Shorts back in 2008, all the banks ran algorithms and numbers based on, if we topped out at 8% in defaults, they were fine. Well, that's really when the shit started to hit the fan. Commercial, it's a little bit higher, but we're seeing the steady climb climbing there, especially when you start looking at all this stuff adding up, going over, because basically all this, the red, the red, yellow, blue lines. If you're listening to this, I highly encourage you to check it out. But the blue line basically is the DQ and or short sales. Yellow is the special servicing, and red is the delinquent mark. So, and this is all across all property types. So delinquent mark for all property types is it's at the 5.5% mark. The special servicing mark is at just under, no, it's right at 8%. And then in DQ and short sale is that 8.35. Now, the distress rate for all property types increased from 7.61 to 8.35. It's a 74 basis jump in April. Okay. The previous high was just a month earlier in March. Okay. This rate was significantly affected by one large loan, which impacted the segment distress. And that big loan was the big change that took place. And it says multifamily saw a whopping increase distress rates from 3.7 in the March print to 7.2. The increase is mostly attributes to a $1.75 billion loan or $561,000 unit backed by Parkmerced, a 3,221 unit multifamily property in San Francisco. There's no surprise San Francisco is seeing a lot of stuff. But imminent non-monetary default caused the loan to transfer to the special servicer with a looming maturity date of December 2024. We will probably see that asset on the foreclosure market. Furthermore, the asset has been underperforming with a below break-even DSCR of 0.47. Remember, they want most of them to be at 1.25, but this is at 0.47 and at only 83%, 83.5% occupancy. It's important to note that CredIQ's distress rate factors in all CMBS properties. They're securitized in conduits and single borrower large loan deal types. CredIQ tracks Freddie Mac, Fannie, Ginnie Mae, and CRL, CLO loans, which metrics in separate analysis. Now, this big loan in San Francisco consisted of townhomes and tower apartments, units spanning 152 acres. Approximately 17% of the units were leased by students at origination 2019, prior to COVID. As the property is across the street from San Francisco State University, Parkmerced was underwritten for a $2.1 billion in September 2019. Now, they go through a whole lot more information. Take a look at this. It talks about retail, the hotel saying it notched it out. But what I wanted to bring this up to you guys is share this chart, which kind of breaks down how all that stuff kind of penciled out. Okay. When you see the distressed loan payment status of this stuff here, it tells you out of the whole bundle that 24.5% are current. And this is a total of like the 8.35% total as a whole. Okay. It kind of breaks it out how it is. So 24% of that number, they're actually current. A little bit, 1.1% is late, but in a grace period. 3.4% are 30 days late. A little bit of 7.8% were late, but less than 30 days DQ. 1.2% were 60 days delinquent. 16% were 90 days delinquent. 9.2% were performing matured, means that their loan matured, but they were still paying on time and the lender was working with them. But a big whopping 36.8% were non-performing matured. They stopped making payments. They've matured. They can't get refinanced. The bank may not be willing to work. There's a whole variety of things that you got to take into consideration on a property by property basis. But this is something to think about the distressed loan payments, that where they're at as a whole out of the whole distressed market. When you look at that, the whole 8.35%, what is that? How does that all break down on an individual by individual basis? So yes, you have some that are current, some are late, but they have in a grace period, late with 30 days queue. But you start having significant, you start looking at the 36.8% that are non-performing matured. The performing matured is another 9.2, and then the 90 plus days delinquent. That's a serious. That's basically 52 plus 9. So basically 60% of the stuff out there is it's matured. It's stuff that they can't get refinanced out of. And that's what you're seeing a lot of. I mean, these loans, they were taking out short-term loans, 3 to 5 years. The idea they're going to refinance out. Well, we know what's happened. So it is, we will probably, I'm going to go a bit. We will see an increased default rate take place over the next few months. I think each month it's going to get worse and worse and worse. Now, how does this make for an opportunity for you? Well, obviously, a lot of this can be bigger loans. You're not going to, most of you aren't going to go out and buy a 1.2 or 1.5 or $2 billion loan. Okay. But what you can do, here's what you can do. It's the one-off individual stuff. I'd be reaching out, everybody on here, if you're into this stuff, be reaching out to your local banks, your regional banks, especially if you're buying commercial stuff locally and you know the market. There's a lot of opportunity out there. Now, the bigger stuff is difficult, but there's a lot of smaller stuff. Like we're talking to a bank here in Texas, expecting to get a big list of smaller balance commercial stuff that they want to sell off their books. And those, if they're occupied, give you some great opportunity to either work it out, rework their terms. If you can buy it at a discount that makes sense to make it a win-win, or buy stuff at a cheaper price and hold on to it. Just buy it and hold on to it. Build that into your model of whatever you're raising capital for your investors. Hey, we need to hold this. We're buying it at a discount and ride that wave for 3 to 5 years, and maintain it. Obviously, have enough funded for capital reserves for taxes and stuff like that as things go on, management, stuff like that. But there's opportunities, ladies and gentlemen. And that's one of the things that we're going to be focused on. We'll be bringing in more experts on some of this commercial debt to talk about their assets class, to give you guys some insight. Highly encourage you to check out some of the different deal flow that we're posting, some different tapes. You know, we had that tape of 188 non-performing notes that are all residential. Take a look at that. Get your marketing down, sharing with your audience. This is an opportunity to be picking up some commercial assets at a significant price reduction. And if you have a plan, that's a big thing. You got to have a plan. I wouldn't necessarily be buying apartment complex. You got a plan there. If you can buy it cheap enough at a price that makes sense, where you can turn around and rework it and modify it of some sort, that's great. Or if you have a takeover management where the cash flow will pay a good return. So that's probably the two biggest things. Some of this retail stuff, it's smaller stuff. Maybe you can re-gentrify it. Hotels, motels, what's going on in that city? Can you convert it to more affordable? Can you Section 8 it? Can you turn a hotel into an apartment complex? I've got some friends that are buying industrial because there's more storage stuff that they're doing with that. Obviously, land, can you convert it to an RV park, mobile home park? It's all about conversion and being flexible and working with the city to really kind of fill in what they need is one of the biggest things I take a look at. So I hope this is helpful for you. We'll put the full link to the full article in the comments. Go check it out, watch it, comment. If you like this stuff, hey, leave me some comments on the video, guys. I'm always here for you to help you. If you'd like to see some specific stuff on the commercial stuff, please feel free to reach out to me or book a call at talkwithscottcarson.com. We want to answer your biggest questions and put experts here for you guys to learn from. So go out, take some action, buddy, and we'll